Hey guys, welcome to another video. In this video, we'll be taking you through how and why we chose to invest in Kathmandu. What was the reasoning behind why we felt so confident in buying a lot of stock at 50 cents? And why we sold at 92% profit. Just a reminder, if you haven't watched our previous video, we advise that you watch that video first before continuing on with this one. Cool, so now that's over, let's move on to the good stuff. Everyone has their own way of choosing a company and how they choose to analyze it. This is how we choose to analyze a company, and that's what we're going to show you here today.
When analyzing a company, there are many things to consider, but these are the basic key points we look at. The first thing we look at is their past performance. We usually look through at least 7 years worth of financial statements for both revenue and profit. In this instance, we can see that both revenue and profit have been gradually increasing through the years. In our eyes, this showed that Kathmandu had a good history of being profitable consistently, while also showing an upwards trend throughout the years, so past performance was a plus point for us.
Now that we've looked at the financial statements and they seem pretty good, how did we decide ourselves whether 50 cents was overpriced or underpriced, especially with the current ongoing situation around the world? Well, with the capital raise of 207 million at 50 cents, 414 million new shares were issued, resulting in a total share count of 709 million shares. This means that at 50 cents a share, it is equivalent to buying a whole company at a price tag of 350 million. To us, it seemed like a bargain to be buying a company that makes 60 million a year at 350 million, which means Kathmandu will be generating 17% in value given the profit stays constant.
Now, in this current situation with the virus around, it is almost certain Kathmandu will take a big hit and may make a loss this year, which potentially could drive the price down further. However, with a strong balance sheet from the extra $207 million they raised, we were willing to bet that Kathmandu could weather the storm and start to recover within a year or two. If the price had gone below 50 cents, we would have bought more. That's how confident we were. Being able to buy a company that makes 60 million a year at a value of 350 million is rare to find these days.
Now, coming to the main reason we sold. Even though we were confident in Kathmandu, with the recent rally in the stock market, the plunged Kathmandu stock went up significantly. Our reason for selling was very simple. Everyone would agree, Kathmandu's sales would have been heavily impacted by the virus, and its future prospect for the rest of the year is very uncertain. Before the virus, Kathmandu, that was making 60 million a year in profit, was valued at a market cap of 680 million. Now, with the dilution of the shares, if you do the math, 96 cents is equivalent to the before dilution price of $2.30. At both prices, the company is still valued at a market cap of 680 million. Do we really think that the company will still make 60 million in profit this year and be worth the same as it was before the virus? We don't think so. They are likely going to take a huge hit, and that is why we sold. There was no way the company was worth the same price tag as it was worth before the virus. To us, it was very overpriced at 96 cents.
Now, the share price may go up higher and we may miss out on some additional gains, but the risk versus reward wasn't equal. We believe that the risk was far greater and the stock was overvalued. Timing the market is not something we can do, so all we can do is use our logical reasoning to make best possible decision.
We hope you understood how we thought this through when buying and selling. If you have any questions, feel free to drop them below. This is just the base of how we look into a stock. To find out more in-depth details on how we analyze a stock, smash that like button, subscribe, and we'll catch you in the next video.